Today's lesson will be Chapter 14, Problem 4B. This is the second take of this particular problem. First of all, before we get started, we need to talk about callable bonds. And callable bonds are bonds that can be redeemed before they mature. That means they can be bought back off of the market after we have already sold them. The bonds can be redeemed at a price that is stated in what we call the bond contract. Sometimes that contract is also called the bond indenture. The bond contract is the contract that happens between the bondholders and the company. The bonds will be called back at what we call a call price. That call price is usually stated as a percentage. The amount that the bonds are called back for is usually different than the carrying value or the book value of the bonds at the call date. When this happens, there's a difference that you will record as a gain or a loss on the redemption of bonds. If the carrying value or the book value of the bonds is more than the callback price, there will be a gain on the redemption of bonds. A gain on redemption of bonds has a normal credit balance. That means it's going to increase on the credit side. If the carrying value or the book value of the bonds is less than the call price, there will be a loss on the redemption of bonds. This loss on redemption of bonds is a loss account and will have a normal debit balance. That means it's going to increase on the debit side. So if you're wondering what the carrying value or the book value of the bonds is, it's the face value of the bonds plus or minus any discount on the bonds. In this problem, what we're going to be doing is journal entries. So we're going to look at the first journal entry for July 1st, where we're issuing 55 million of 10-year 9% callable bonds that are dated July 1st, year one, at a market rate or effective rate of 7%, receiving cash of $62,817,040. The interest is going to be payable semi-annually on December 31st and June 30th. Those are the interest payment dates. When we look at the journal entry for July 1st, it tells you the face value of the bonds. It also tells you the life of the bonds are 10 years and that there is a 9% interest rate on these bonds. Because the 9% interest rate on the bonds is what we refer to as the contract rate of interest, it's different from the market rate of interest, which is 7%. And what this means is that the bonds are selling above the face value of the bonds, which means they're selling at a premium. It's all about the interest rate, the contract rate of interest, and the market rate of interest. If there's a difference between the two of those, in this case, since the contract rate of interest is more than the market rate of interest, the bonds have sold at a premium. And we're going to put that in the premium account. Notice on July 1st that we debited cash for $62,817,040. That was what was given in the requirements for the problem or for the July 1st entry. The bonds payable is always going to be credited for the face value of the bonds. In this case, the face value of the bonds is 55 million. The difference between the cash that you are receiving for the bonds and the bonds payable account face value amount, the difference in this case is a premium, and that premium results because the contract rate of interest is higher than the market rate of interest. So the cash was given, the face value of the bonds was given, the difference between these two is the premium. So 62,817,040 minus 55 million will give you 7,817,040. On October 1st, we borrowed $450,000 by issuing a 6-year installment note to Intexicon Bank. The installment note carried 8% interest. So we're borrowing $450,000 at a interest rate of 8%. The note is considered to be an installment note, so it's going to require annual payments of $97,342, and that first payment is actually going to occur on September 30th of year 2. Notice this is October 1st. This is when we're borrowing the money. So we simply debit cash and credit our notes payable for the amount that we have borrowed. The amount of the installment note, the principal amount of the installment note was $450,000. So we debit cash, we credit notes payable, which is the liability account. When we credit it, the liability account is increasing. We've got to pay back $450,000, but we're going to pay it back in installments, which include interest associated with this journal entry. On December the 31st, the end of the first fiscal year, we have accrued $9,000 of interest on the installment note. What that means is that the interest that we owe at December 31st from the borrowing transaction on October the 1st is the amount of $9,000 that they give to you. Since this is an accrual of interest expense, our interest expense will be debited because it's increasing. Our interest payable is also increasing, but we increase interest payable, which is a liability on the credit side. So this is an example of an adjusting entry that would be made at the end of the first year on December 31st for the accrual of interest expense. On the second December 31st entry, we have paid the semi-annual interest on the bonds, and the bond premium amortization is going to be $390,852, which is combined with the semi-annual interest payment. Now, you can make two separate entries, one to do the semi-annual interest payment and one to record the amortization of the bond premium. In Cengage, they want you to combine it all together, so I'll tell you about how we determine the amounts for this particular transaction. First of all, we're paying the semi-annual interest on the bonds that were issued. We had issued 55 million, and so 55 million would be multiplied by half of 9%, which is 4.5%. That would give you the entire 6 months of interest that is owed on the bonds. The interest that is owed on the bonds would have been debited to the interest expense account, and then we would have credited the cash amount for the interest on the bonds. So the total amount of interest that we have to pay back is, or the cash amount of the interest that we're going to have to pay back is the semi-annual rate of interest. That's the cash that would be credited here. And so what I'm going to do, as you can see, I've got a formula up here. If we looked at the B column and 23, that's this amount right here, which is the amount of the bond interest expense, plus B24, which is the premium on the bonds payable. So let me show you how we would do these separately. If we're determining the semi-annual interest on the bonds, what we would need to know is the face value of the bonds. So 55 million would be multiplied, 55 million would be multiplied by half of 9%. Which is 4.5%. So if we were making the interest payment, the amount of the interest, the total amount of the interest expense would be $2,475,000. But because we have amortized the premium, which means that we will take the premium amount, the whole premium amount was $7,817,040. That was the total amount of the premium. We will divide this by the amount of the periods that are in this bond. Since it was a 10-year bond and we pay interest semi-annually, the amount of periods that we would amortize are 20 periods. In other words, 10 times 2 is 20. So I'm going to divide the premium amount by 20 periods. And that's how they got the 390,852. Now, when you amortize a premium, you are reducing the premium by debiting it, and then you would credit the interest expense, which means that this amount right here is reducing the total amount of the interest payment. And that's how I got the interest expense amount here. In other words, this minus this is 2,084,148. That's how you get this debit amount here. So if you were paying the semi-annual interest, the amount of semi-annual interest that you pay is 2,475,000. The amortization of the premium was 390,852. When you combine these two together, it will give you the total amount of the interest expense. Notice the premium was debited for the 390,852. That debit amount is reducing this premium on the bonds payable. So we are debiting it to reduce the premium amount. When you amortize, you're reducing the premium. The two of these combined is the total cash amount that would be paid out. Notice that cash amount is equal to the bond interest expense payment. You see how we got that there. On June 30th, which is exactly 6 months later, we are paying the semi-annual interest on the bonds, and we are amortizing the bond premium for 390,852. In other words, we're doing the very same thing that we did in the previous entry. So it's the very same accounts that we're debiting and crediting, and exactly the same amounts. That's what would happen on June 30th. On September the 30th, we paid the annual payment on the note, which consisted of interest of $36,000 and principal of $61,342. Notice that the $61,000 and the total amount of the interest, both of these combined, is the cash amount that is decreased here. So we're paying an annual interest payment on the note, which amounted to $36,000 in interest plus the principal amount. We are reducing or debiting our note payable by the amount of the principal that would be reduced. Our interest payable also has to be reduced because if you remember, we created an accrual at December 31st from a previous journal entry of $9,000. That interest payable now, we are now paying in this particular journal entry. So the amount of interest that really is interest expense during this period of time is $36,000 minus $900, which will leave you with $27,000. So at September 30th, we had total interest at $36,000 because $9,000 was recorded last year. The remaining $27,000 has to be recorded this year. When you add up your debits now, they equal your credit. On the next December 31st, we have accrued $773 of interest on the installment note. Our accruals are adjusting entries that we make at the end of the period where we are debiting our interest expense for the amount of $7,773. We will credit our interest payable because we owe that interest, but we're not actually going to make an interest payment until it's time to make an interest payment, which is on June 30th of the next year. So this is just an accrual at the end of the year. On December 31st, we also paid semi-annual interest on our bonds this time. The bond premium amount was again $390,852. And so we will debit our bond interest expense for $2,084,158. Notice it's exactly the same as what we did the last June 30th. These entries just start to repeat themselves over and over again. We have reduced the premium amount by the amount that is amortized, and then the total amount of cash is what we have paid out for the semi-annual interest. And again, we've done the calculations for this earlier up here. So if you want to look back at that, you can. It's the very same journal entry that they're doing there. Then on June 30th, they actually called back the bonds, or they redeemed the bonds. They recorded a redemption of bonds, which were called back at 103%. This is a percentage here. The balance in the bond premium account is $6,253,632. After the payment of interest and amortization of the premium have been recorded, they want you to record the redemption only. That means that we are redeeming our bonds back off of the market. The bonds had an original face value of $55 million, and that comes from this part right here in requirement number 1 for journal entry on July 1st. Our face value is going to be debited. The premium amount is the amount that they have left in the premium at this particular point in time. The amount of the bonds payable plus the premium would be the carrying value. And we're going to compare that to the callback price or the cash amount that we paid for these, to recall these bonds. Remember, we recalled 55 million at 1.03%, 103%, or if you put it in a decimal, it's 1.03. That's how we figured up the 56,650. In other words, I've calculated that for you right here. 55 million times 103% is 56,650. That's how we get that cash amount. That's the callback price. And we would compare that to the carrying value of the bonds. The carrying value of the bonds is the face value of the bonds plus the premium. And at this time, the premium was given at $6,253,632. These two added together is the carrying value of the bond. The carrying value is more on our books than what we paid to recall the bonds. So the difference between these is what we call a gain on the redemption of bonds. Gains are credited to increase them. They are an increase in your income or your revenue. So they actually, the gain on the redemption of bonds, you would find on the income statement under other revenue and other gains. This is an other gain here that we would be recording. So again, I've showed you how to get that amount of the gain here. And I've also shown you what it would look like for the premium on the bonds payable. So this is what the amount of the premium on bonds payable was on July 1st. You can get this from the first journal entry that we recorded. This T account represents the ledger account. So we started with a credit amount from July the 1st. Then on the 1st December 31st, we debited the premium when we amortized it, and then we debited it again on June 30th. We would have debited it one more time on the next December 31st, and the balance at this point in time would have been $6,644,484. That's the balance at the end of the first year. Well, actually, it's the second year. And at June 30th, we amortized it again. This gives us the remaining balance, and that's how they came up with this balance right here in the June 30th transaction. So we just kept a record of all the transactions that have happened up to June 30th. And that's how they came up with this amount that they actually gave to you. But I just wanted to state that again in a T account so you know what was going on there. Then on September 30th, we had another transaction where we pay in the annual payment on the note, which consisted of interest this time at $31,093, and the principal was reduced by $66,249. So first of all, we would pay back the amount of the interest plus the principal on this installment note. The cash amount would be credited for the two of these combined. That's how they got the cash amount. The note payable would be debited for the principal of the note. You made a payment toward this note, so you're reducing the principal of the note, in this case by $66,249. We had some interest that we had accrued from a previous year-end transaction. That interest that we accrued was right here. So the interest payable has to go away. To make the interest payable go away, we would debit that amount to the interest payable account. Because this was accrued and the total amount of interest was $31,093, the difference between these two is the actual interest expense at September 30th, or the interest expense for this year from January to September 30th. In requirement number 2, they're asking you to determine the interest expense for year 1. So I just went back and I posted every time we created an entry that affected interest expense, I posted those to this account to get the balance at the end of year 1, which is what they wanted in requirement 2, the interest expense for year 1. The interest expense for year 2 would have started with the interest expense in year 2, which was at June 30th, we had some interest expense that we incurred in year 2, and at September 30th, we incurred some more, and we incurred some more at December 30th, and then at December 31st, we incurred some more. So the total amount of the interest expense that we incurred in year 2 is $4,203,069. All of this came from the above entries. I just posted them. This was year 1, this was year 2. In requirement number 3, they're asking you to prepare a balance sheet as of the end of year 2. So we will start with the face value of the bonds, which were $55 million. And we're going to add the premium on bonds payable, which is the balance of the ledger account at December 31st in year 2. And we find that this is the ledger account here, the premium. These are the journal entries that we created until we get to this balance at the end of year 2 at $6,664,484. We would subtract that to find the carrying value on our balance sheet. Bonds payable is a long-term liability. So this would be in the long-term liability section. The bonds payable is always recorded for its face amount. If there is a premium on the bonds, we need to record that. And that premium at that particular date amounted to this. We started out as a premium here, but you amortized it 3 different times to get a remaining balance of $6,644,484. The difference between these two is the carrying value, and that's what would go on the balance sheet at the end of year 2. And this is all of this particular problem. I hope this has helped you. I'm going to stop sharing the screen, and I'm going to stop the recording.